Hello there, friends, family, to my entire extended, audience there. This is Bill Griesmer from Stonegate Capital. Just thought I would put together a short video for you here this afternoon. I am here in Dallas, Texas at the Westin Galleria Hotel. Scott Carson of We Close Notes is having a mastermind here, and then it's going to be followed by 2 days from the Quest Company, their self-directed IRA company. A lot of note investors know, but a lot of the general public does not, that you can actually buy, real estate and all kinds of other quote unquote alternative investments in your IRA. And if it is a self-directed IRA, then you can do that tax-free. So I'm really looking forward to this event. I've been, kind of thinking and planning about this for, well, a couple weeks now, because I've had other events going on also. So anyway, I got to my hotel here this morning, and I was trying to use my time constructively, and I was just doing some research then online. And it's really funny. If you've been following me on social media, I've posted some of this. Even reading on a website, for example, some websites that we use for information in the note investing space, you can read different points of view on the same website on the same day. It's pretty fascinating, actually. So what I mean by that is earlier today, I read a report where Freddie Mac is kind of projecting positive continued growth in the real estate market through the end of 2019, so almost a year and a half from now. And then I think just exactly right below it on the website page, it also then talked about at the same time, though, the risk of default is increasing. And I don't know for sure how they get these numbers, but the risk of default on mortgages right now, it's actually come up now to the highest point since 2015. So at the same point, you just kind of, the things that make you go, So how is it then that, they're projecting that the real estate market will continue to grow and progress? At the same time, they're saying that, the risk is rising and it is already higher. So I just find it interesting. No one really knows the future 100%. If you're thinking Freddie Mac holds all the information, well, I don't think they correctly forecast, the events of 2008, 2009, 2007, late 2007, thereabouts, what has come to be known as the Great Recession. So then I was thinking about how that affected people like me and my friends, kind of smaller note investors, really the whole note investing, group as a whole. And it just becomes more important than ever to really have your processes narrowed down and nailed down, especially with regards to due diligence and looking at your valuations and making sure that, you've got some margin for error. Just really, really round numbers. So say you'd bought, a note and property at a 50% discount. Well, even if it falls in value then by, say, 30%, you've still got some margin there, okay? You should still hopefully be able to come out whole on the deal. You might not make as much money if the, real estate market really does decrease, but you've got a margin of safety there. Versus if you're doing, a very narrow deal. So say that same deal, say like you were only projecting maybe a 30% return. And like I said, then the market does decline by 25%. Well, then, your margin of error is much, much smaller. However, at the same time, let's face it, we're all dealing with the real world here, and especially in the non-performing space, it is becoming at least a little bit harder to find notes, most people would agree. So you do have to kind of see what you can find out there. So my point is then this got me thinking, and I put together just a short case study of a performing note that my company purchased here. Since I'm in Dallas, I don't have my whiteboard right behind me, so we are going to be kicking it old school here. I got just a sheet of paper here. So this note that I purchased, we got it in St. Louis, Missouri, And this note was originally signed, agreed upon in 2006. And then it was modified in 2011. So at this point now, the term remaining is 2016. The unpaid balance on it is almost $37,000, and the monthly payment is now almost $300. The monthly payment came down a little bit with the modification because they did lower the interest rate. However, it had another little twist I'm going to get to in just a minute here. So the interest rate after the modification here got down to 6.8%. However, this one has a little bit of a kicker. So starting about middle of next year, the interest rate was going to start to creep up a little bit year by year. It's not a true adjustable rate mortgage in that it's tied to, the prime rate or something like that. This one actually calls for, per the contract, for the interest rate just to go up. So that will actually increase my yield. And I'll be perfectly honest, I tried to mess around with this for quite a while today. I'm not quite sure how to figure for that with regards to my yield. But I bought this note for just under $25,000, around that. And then my yield even on that is going to be 12.9%. And then, like I said, that has the potential to even go up higher because the monthly payment is going to be going up over time. So I talked about trying to decrease your risk. Your due diligence becomes even more, where is it at there? There we go. I know this is kind of old school here. So the market value, very, very, very important. That's the as-is value. It doesn't get much better than this. On this particular house, this house was worth $196,000 approximately. That is per a local realtor in the area who did a drive-by for me and took pictures of the property. The taxes on that asset, I did call myself. I both checked online with NetR Online, and then I called the county myself personally just to double check that and make sure there wasn't something else going on that maybe hadn't been not put on the website yet. All the taxes checked out, so that was real good. I personally called the utilities and made sure that the water was on. Okay, they're current on their bill also, not a big outstanding balance there. Then you want to check the rent rate. I checked the rent rate, what it would cost them to buy this house, or excuse me, to rent this house. It's $1,150. So that makes their purchase price of their monthly payment of just under $300. You can tell that's a huge bargain by, $700-800 there approximately. And then looking at some other of the math figures that we do, the investment to value on this is all the way down to 12.5%. My equity, I define that as the difference between what I have in the deal and then what the house is worth. It's $171,000. So if worse came to worse on this deal, if it did go to foreclosure, there's a very high chance this would just sell at foreclosure auction, and I would at least get what I put into the deal. Okay, actually more than that, because I would get the unpaid balance. No, I would not get the whole cost and value of the house, but again, still I'm coming from a fairly strong position. The borrower has a lot of equity also, and let's face it, that's a good thing. That borrower is going to be more likely to want to just continue to make that payment and stay in the house. And then the investment divided by the unpaid balance is just 66%. That's pretty good also. I'm buying that unpaid balance at only, 2/3 of the price of it approximately. I also checked the title on this. I had a O&E title search done by Pro Title, even though this house has title insurance. So that was a really good thing also. And then very importantly on a performing note is the pay history. They had a very, very, very good pay history. Not 100% perfect, paying on the first of every month, but 80% they were paying within the first week. In this space, that's really pretty good. So I did say the last thing would be the risk then. I did say this deal, of course, is not risk-free. There is no 100% risk-free anything in life, really. Investment, I guess possibly a bank. If you're would be happy with, you know, a 1% return, a 2% return, something like that. But even there, as we saw in, you know, the Great Recession, you know, banks can go out. Your account's probably insured by the, excuse me, FDIC if you get to that. But I told you my rationale for this this note. It has several things that put you in a strong position. So that's it. Wow, I see a lot of people joined in here, actually. That's great. Dirk Ward, Clifton Sadler. Clifton, I can't remember if you're coming this weekend. I think you are. Hope to see you here, buddy. Chris Sampson, Ben Fredericks. Ben, I hope your company's doing well. Dave Hauser, nice to see you on here. I love the notebook, old school. Well, we adapt, you know. I couldn't, you know, I think what is it, the TSA, I don't know how that would go over if I tried to carry, you know, my whole big, you know, whiteboard underneath my arm as I got on the plane. Although it was pretty sweet. I had two seats empty next to me. So that was just fantastic. Cedric Wilson, I know for sure that you're coming here this weekend. And then Ginny and Karen, I hope everything went well at the office today. And Patricia Shea, we've got some physical therapists chiming in here and checking this out. And that is really good to see. All right. Well, thanks again, everyone, for watching. Does anyone have any questions for me here? We are here in Dallas, like I said, getting ready for the Node Expo. I'm about to go hang out with Chris Seveny and some other, you know, really smart note investors. Laura Blunk's going to be there. I know Scott Carson is on his way. I know Natalie Patton is going to be here for this. I know Cody Cox, I think, said he's going to be here. Katie Moten, we will miss you. I know you're not going to be able to make this one. Wayne Snell also, I know you're not going to be here, but you're looking after family, which is important. So, all right, couple shout outs, but no questions here. Well, thank you very much, everybody, for listening. That's kind of the things that we go through in note investing, which gives you a little bit of insight as to how we go about business. See you in a couple days, bud. Yep, you got it, Cedric. I look forward to it. All right, really good. Thanks again, everybody, and have a great day. Bye-bye now.